There are a lot of ways to increase your credit score to qualify for a better mortgage interest rate. This is Ron Wysakarski for the Black Hole of Real Estate, and I am finding more and more people that are really digging in deep when it comes to their mortgage pre-qualification and the interest rate that they want to earn. Yeah, that's what I said, earn that interest rate. So there are so many places now that you can check your credit online without getting a ding, so to speak, on there, or a major like credit pull, a credit hit that kind of brings your score down. And when you're applying for a mortgage, what we have found is that the bureaus are looking at any inquiries for mortgage related activity as one if it's done in a 30-day time period. So you're allowed to shop. And even if it racks up several inquiries because you're shopping interest rates, it's going to count as one, and that can help you out when it comes time to actually making the purchase. Now, your credit score can be anywhere from like a 450 to an 850 under most credit models. And when you're looking specifically for a mortgage, the 850 is typically the upper barrier for most lenders. Now, there are different credit profiles that the bureaus are looking at when it comes to lending practices. So, for instance, the score model that they look at for a mortgage is much more stringent than maybe the one for a department store credit card or a car loan, or maybe they're checking, for insurance or something like that. So there's different models for different reasons. But we are most familiar with the mortgage one, although I think that most people actually use the car loan one when it comes to most things, something like that. So your score can be a little bit higher. If you're going for the vehicle or the furniture store, things like that, you're more likely to get an easy approval, probably not even with documentation. Now, the mortgage side, a lot different. They're going to check, 2 and 2 years pay stubs, or 2 months pay stubs, 2 years of taxes, 2 months of bank statements, things like that. But as far as your score, what affects that? So let me give you a quick rundown here, and you can go to any of the portals. I'll give you the longer version of this. But the number of trade lines that you have open, most lenders are looking for 3 for a mortgage, 3 open and active trade lines. So if you have a car loan and it's at the end of it, paying it off might make your debt to income ratio look better, but it closes out one of your 3 trade lines. So I'm not sure that I would close out any trade lines, especially if it's a car loan and it's less than 10 months due in payments. They're probably not even going to count that in your ratios anyway. So I wouldn't necessarily close out a trade line in order to qualify for a mortgage. Now, I would also tell you that getting a credit card opened to have one of your trade lines is good, but maxing it out, not such a good idea. So if you get a credit card with $1,000 limit on it, look, if you want to put $50 on there for gas and $100 for groceries, that's fine, but pay it off. Let's not pay interest unless you have to in order to qualify for a mortgage. Now, that new trade line is going to affect a couple of things, but maybe you've got 2 credit cards and a car payment, or maybe you got a student loan, a credit card, and a car payment. Okay, those are good. There's your 3 trade lines. Probably not closing those out to go below 3 is a good idea. And if you have more than 1 credit card, they're going to add up all the limits and all of your balances and compare that. And they want to see less than 30% use. So if your credit cards have a total of, let's say, 10,000 usable credit, and you're actually using 3,000, you're in that area. Less than 3,000, probably a better idea. And some will tell you somewhere between 5 and 10% usage is a good one. Now, if you're on the other side of that, and let's say you're using 8 out of your 10,000, that's going to bring your score down because most of your available credit has been used, and that could be an indication to a lender that maybe you're going further and further into debt. You may not be a good risk or the best possible risk for them to loan money to. Hope that makes sense. Now, if you are finding yourself in the length of credit history, and maybe you've had a student loan for 10 years and a car loan for 2 years and a credit card for 2 years, and you pay off your student loan, well, if you look at 3 trade lines and you take 10 years, 2 years, and 2, right? It's 14 divided by 3. It's almost 5 years of the average age of your credit. Now, if you lop off that student loan and it goes away, the only 2 left that you have are 2 years each. So congratulations, you paid off your student loan, but you took your average length of credit from 5 years down to about 2, and that could actually affect your score in a negative way. So again, be careful when you're closing things out and understand what is the cost benefit of that. That student loan that you're paying off, you've probably paid all of the interest or most of it. The interest is negligible. You should be putting more money towards a credit card payment, or maybe there's more money in savings while you're going through this process so you can have a bigger down payment. Now, the last piece of this, the way that you can affect your interest rate, the higher the score, the better, right? Okay, so we got that down, and in almost every case, a higher score is better. I can't think of too many where it's actually not. And then looking at the debt to income ratio, that's less than half of your money that you earn gross is going to be allowable for your mortgage, and that includes things like car payments and student loans and your credit cards. So we got to keep the debt to income ratio probably below 45%. And then the other thing that we're going to look is how much credit is in use. And if you're using most of your credit that's available on credit cards and things like that, that's also going to leverage you a little bit higher into the risk category. Now, once they look at all these risks, they're going to assign an interest rate. So if you're on the risky side, you get a higher rate because it's a higher risk. And if you're less risky, well, now you get a lower rate because you're lower risk. And I hope that makes sense. So if you're looking to close out a credit card or a student loan or a car payment, that could be a good idea unless it pulls you down below 3 trade lines, or if it pulls you below that area we want to be in for the length of credit. So paying something off to take your length of credit from 5 years down to 2, probably not so good when you're applying for a mortgage. That's a lot to take in right now, but I want to make sure that we're adjusting this for you. So this way you get the highest possible score, the best possible application, easiest approval, lowest rate. This is Ron Wojciechowski for the Black Hole of Real Estate.